Hello everyone, happy Friday and welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, as you can see, it's been a pretty busy day in terms of economic data, although the majority of it was all released at the same time. The US and the Canadian jobs reports being released at 1:30 UK time, 12:30 GMT. Aside from that, today it's been a little bit quiet. The key events really do just stand out for you here. We did have the RBA monetary policy statement overnight, but I don't think there was anything too significant about that. Nothing that really struck anyone by surprise. Really just again reiterating some points made previously about inflation and unemployment, the economy cooling. The only maybe potentially surprise note was the talk about the housing market being a contributor to the decision to cut interest rates. But aside from that, there was nothing greatly surprising from the statement itself. The key event today, without a doubt, and unsurprisingly, was the US jobs report. Heading into the jobs report, I think there was this belief in the markets, I guess, that the economy is not performing well. We saw that the CME Group FedWatch tool was showing that even going out to July next year, that there's the probability of interest rates staying the same was greater than the probability of rates rising. So clearly, people were very dovish about interest rates heading into this jobs report. And I think what made this jobs report quite significant was the fact that had we seen another bad number, anything close to what we had in May, that would have meant that not only have we had 2 consecutive quarters of weak growth, we've also had 2 out of 3 months where we'd had weak jobs data as well. And combined with everything else and the growing economic risks, the low inflation, the low wages, I think that may have been potentially enough to convince the Fed that this year is just not the right time to continue raising interest rates. And while it may have been right to start it last December, things have changed and they need to maybe need a cooling off period. And while one report in itself shouldn't change too much in terms of people's views, I think this has really left a possibility alive that we could see another rate cut this year, again probably in December if we are going to see it. And it was a very good jobs report as well. Not only did we get a decent jobs report, we actually got a very strong jobs report. The non-farm payrolls figure showing 255,000 jobs created in July. Not only that, we actually saw the last figure revised up to 292,000. Not only that, we saw the 11,000 figure from May actually revised up to 24,000. Still a terrible figure, of course, but these are upward revisions to the last 2 months, and this month's number far exceeding last month's as well. Not only that, we saw the average weekly hours worked rose from 34.4 to 34.5. On top of that, we saw participation rate rose from 62.7 to 62.8. And we saw the average hourly earnings up to 0.3% from 0.1% last month and 0.2% expected. So a whole series of good figures here and that we saw from this jobs report, and really did provide a boost, not just a boost to sentiment, but we actually saw a boost. We saw a boost to the dollar, of course, because this will only aid interest rate expectations. But we also saw a boost to the stock market as well. People not necessarily fearing an interest rate hike. It would seem the S&P 500 actually rose to all-time highs shortly after the open in response to that jobs data. We are seeing decent gains in the Dow as well. It looks like that could be headed for all-time highs in the not too distant future. Also, like I said, we saw a rally in the dollar, which we can actually see on the next slide here against the euro. It pulled back from around 111.50 back down to around 110.50. Clear momentum, downside momentum in euro dollar right now. We could potentially extend this. From a technical analysis perspective, it will be interesting to see how we do respond around that 110.50, 110.60 level. This is the 61.8% retracement of the move from those July 24th lows to August 2nd highs. And if we do see a rebound higher off here, it may potentially suggest that the downside in euro dollar is not potentially is not going to be as significant as the move today would suggest, although momentum clearly, at least recent momentum from the last couple of days, is very much with the bears in this case. It will, if we see the break of 110.50 back towards 110, then that could be a very bearish signal indeed. You can also see that we had a similarly negative reaction in cable as well. The 131 handle, which held following the Bank of England's decision yesterday to cut interest rates, to increase bond purchases, to announce a new 10 billion pounds of corporate bond purchases, and to announce a new term funding scheme. The 131 handle held throughout all that, despite the fact that this stimulus package exceeded expectations. And it wasn't enough to hold today. We had a strong jobs report, and the strength of the dollar is what's driven the pound through 131 against the dollar, back towards around 130, 130.50 at this stage. But with that major support level being broken, it'll be very interesting to see what happens if we do see that 130.60, 131 level retested to the upside. If it holds, then it could be a very bearish signal indeed for this pair. The next support, of course, being 130, a big psychological level, previous level of resistance as well. And if we see that broken, then we could be headed back towards those 128, 128.50s. But you can see just how big an impact that has had on the dollar. We've seen a similar reaction as well in US Treasury yield as well. Yields up by 6 basis points after this, and I'm sure the Fed funds, the Fed funds futures rates are going to reflect this as well. I'm just checking right now actually to see what the CME Group Fed Watch tool. I'll bring that live onto the screen actually right now. You can see the CME Group Fed Watch tool on here now. September was still clearly priced in for interest rates to stay the same, only an 18% chance of a rate hike there. But if we go out to July, where it was around 56%, I believe, first thing this morning, you can see that's now dropped to 40.5%. Now we're looking all the way back to February. So it's February, so March is when markets are effectively now pricing in the first rate hike here, according to the CME Group Fed Watch tool, which derives its probabilities from Fed funds futures. So you can see that's had a big impact already today. Still to come, like I say, we've got Baker Hughes oil rig count, and that has been rising as of late, and I do think that's feeding into the oil price declines as a result of that. Expectations potentially of future oversupply concerns once again. The oversupply issue never really went away, but the fact that we were seeing production cuts in the US and we were seeing outages elsewhere did help to lend support to oil prices. But the fact that we're seeing the US now come back online, adjusting to the lower price pressures, would suggest that we are headed for further oversupply concerns towards the end of the year. That's all for today. I hope everyone has a great weekend, and I'll see you again on Tuesday. There'll be no video on Monday, but we will be providing an update for the start of the week on Tuesday. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.